Vamos a hablar un poquito de macro, vamos a acercarnos a la gestión de patrimonio. Saludamos ya a Peter Mullineux, es Equity Product Specialist at Alliance Bernstein. Hello, good afternoon. Peter, what are the key reasons to reconsider investing in European equities?
Well, Europe's off to a really strong start this year. If you just look at the markets in US dollar terms or euro terms, the US market's up about 1%, but the European market's up about 10%. So we're hoping that's going to continue for the rest of the year, but there has been this perception that Europe has lacked growth stocks, and it's really driven a huge valuation gap in the market, that even the performance difference that we've seen this year, there's still a lot more of that to unwind. If we think about Europe as a whole, it's actually home to many companies that operate in industries with structural growth drivers. Think about technological trends, healthcare innovation, industrial automation, energy transition, and even luxury goods as well. The great thing about some of these more structural growth areas, such as technology, healthcare, and industrials, is that they're not reliant on macroeconomic growth. So even if your outlook for the economy in Europe is not that strong, there's still an opportunity for companies to grow at really quite high rates. And another key thing about European companies is they really operate in a global market. They're relying on revenues throughout the world. They have global client bases. And so if you're thinking about the regional economic challenges, actually a lot of the operations for these companies come from completely different parts of the world, either from the US or from Asia, from other emerging markets, as well as from these more structural growth opportunities in Europe. And also, let's not forget, Europe is home to some really high quality businesses. They have high competitive advantages, highly skilled management teams, and really strong capital discipline. And they can sustain earnings growth for the long term. So many of these companies actually have just as high quality characteristics as you might see in their US counterparts as well. They've just been out of favor by the market for one reason or another.
How can investors identify high quality business in Europe for long-term growth?
Well, I think there's really three areas, and we'd always start with this focus on cash flows. Cash flows are the lifeblood of a healthy business. And what we're looking for is how a company is putting its cash to work. The cash it receives in, the profits it generates from those cash flows, and then how it can reinvest those profits into the business. They really underpin a company's ability to sustain earnings growth. And ultimately, it's earnings growth that drives stock market returns. It's nothing else. There's macro, or there's market volatility in the short term, but in the long term, it does come down to earnings growth. So to get rid of that short-term volatility, you really need to take a long-term time horizon. And I know that a lot of managers say that, but it's actually really difficult to do it in practice. We're talking about a 5-10 year time horizon for active equity investors. Separate yourself from that market noise, focus on the business, and invest for the long term. Maybe you'll miss a quarter or two. Ultimately, it doesn't matter if you have strength in your conviction behind your business. And what can really help that, thirdly, is to take more of a business owner mindset. So don't think like an investor, think like an owner. Yes, you can look at company accounts. Yes, you can look at the PE ratios and you can run your quant models, but actually prioritize the operational attributes of a company. Look at its factories, look at its shops, meet its management, analyze its competitors. Does it have a competitive moat? Get to know the company really intimately. And you can really only do that when you have a long-term time horizon, because you need to devote a huge amount of time to learning the business. And that will enable you to filter out some of the market noise and just focus on, is the company meeting your expectations? And is the company sustaining that earnings growth that you think will ultimately drive stock market performance?
Are there any particular sectors in Europe that investors should focus on?
Well, a really interesting sector in Europe is the industrial sector. Again, if you compare it to the US, Industrials is quite a small part of US growth indices. It's now so dominated by technology. But in Europe, it's a much bigger part, and it's really diversified. So if you could think of a few areas within industrials, services and spare parts providers from selling tools or machines. This can be a way to take yourself away from economic cycles. Think of the big, heavy industries like mining or large-scale manufacturing. Companies have to make long-term decisions about what machines they're going to buy, and those machines are going to need maintaining, they're going to need servicing, they're going to go wrong, they're going to need new parts. So companies who are making those parts have really quite predictable and sustainable cash flows into the future from looking after those machines. And also less sensitive to the economic cycle. Yes, mining is heavily dependent on commodity prices, but you've still got to buy the equipment and you've got to commit to expanding those operations over time. Another interesting area is to think about companies that can acquire and consolidate. And this seems to be particularly prevalent within the industrial sector. Companies will go out, they'll buy quite niche, more similar, sometimes different companies operating in different parts of the industrial sector. And it's a really effective way for the parent company to grow, to increase its operational footprint around the world, and it can develop that inorganic growth alongside its own organic growth opportunities in the market it knows best. And finally, think about digital transformers. We talked about technology in the US. Well, actually, if you look at industrials and some of the companies in Europe, the way industrial companies have had to innovate now, they're acting more like technology companies. So they're really exposed to these broad technological trends. Think about heating and air conditioning. Over here in England, we have to heat our homes. You there in Spain, you have to cool them down. It's typically the industrial companies that make the air conditioning pumps or the radiator valves. But if you look at the trends of smart homes, more sustainable buildings, they need sensors, they need remote monitoring. These systems are getting much more intelligent and much more connected. So the industrial companies are having to integrate a lot more technology into their equipment and their product lines. So you're seeing this technological innovation is acting at a really high rate within industrials. And it also means that you don't need to focus on specific leaders. You don't need to worry about your big social networks or your big cloud providers. It can be quite niche and also benefiting a lot of different providers, customers, and having a broad customer base around the world as well as in Europe.
And to the end, how can European companies navigate challenges amid changing political landscapes?
Yeah, it's such a hot topic and it's changing all the time. We're particularly looking at the potential impact of US tariffs, and that especially applies to industrial companies. But it comes back to the strongest, well-managed companies, which you typically own in a more concentrated portfolio. These are the ones who will be able to manage the impact of tariffs or the changing dynamics among geopolitics the best. If we think particularly about supply chains, a lot of companies have already had some exposure to this. They had the first Trump presidency back in 2016 to 2020. Then we had the COVID-19 pandemic. A lot of companies had to completely change their supply chains because they couldn't operate internationally during that time. The higher quality companies were able to do that more effectively. They could negotiate better terms with local suppliers. They're better positioned to deliver efficiencies and earnings growth on top of that. And really it comes back to that, looking at how to be resilient amid political change. We've seen a lot of that in Europe. We're now seeing it on a more global basis, but the strongest companies focusing on those resilient companies with durable business models is the best way to play this market environment today. So ultimately, we do think there needs to be a catalyst to reset the huge valuation gap we see in Europe versus the US today. It's nice to see it started to narrow. But the market's been so out of favor for so long. but there are still great opportunities there. Take the disciplined approach, look to the long term, buy companies with great cash flows that can be sustained for the long term. And that's where we think the potential for European growth equities is today.
Peter Mullineux, equity product specialist at Alliance Bernstein. Thank you very much, as always. Bye-bye.
Bye.